We've talked about fiscal policy, so we looked at what the branches of government can do, and now we're going to look specifically at the Central Bank of the United States. So we're going to look at the Federal Reserve and its power over the economy. And so it's time to look at monetary policy. What we see here, this is Janet Yellen. She was the chairman of the Fed um, uh, under President Obama, and so she was the head of the Central Bank of the United States. She's now the Secretary of the Treasury. But we're going to take a look at what the Federal Reserve does and how it can influence economic performance. All right, the Federal Reserve, that's it in the picture. That's the central branch in DC. This is the central banking system of the United States. So this is the government's bank. The Federal Reserve regulates all commercial banking in the United States. The bank that you go to is a commercial bank. So like if you go to SunTrust, Regions, Bank of America, something like that, First Tennessee. All these things are commercial banks. Like regular people get accounts at commercial banks, and then the commercial banks have accounts with the Federal Reserve. So like I keep my money in an account at a bank, and then my bank keeps some of its money at their account at the Federal Reserve. The Federal Reserve splits the country into 12 different zones, and that's like the 12 branches of the bank for the country. And so, like all of the commercial banks use those, and these 12 zones are. This is how we regulate banking in all the regions of the country. So the Federal Reserve, we really just call the Fed. The Fed does a lot of stuff. The Fed has a lot of things to do. The thing we're going to talk about the most is that the Fed controls monetary policy. That's what we'll focus on today. They're making decisions about how much money is circulating, and so they supply the economy with paper money. What that means is they decide when it's time to make more money and when it's time to make money out of circulation. They also make and enforce all the rules that banks have to follow. So if they make rules about overdraft fees can only cost this much and stuff like that, that applies to all of the banks that you and I use. Another really important term that we need to know here is they set what is called the discount rate. The discount rate is the interest rate on loans that commercial banks can get from the Federal Reserve. So when the Fed sets their interest rate, that impacts the interest rate for all of the banks across the country, and that determines what kind of interest rate you or me could get on a loan when it's time to borrow money to buy a house, go to college, buy a car, something like that. So they have control over how expensive loans are for us. And then the last thing they do here is what's called check clearing services. So when when people are using checks to move money from one bank to another, or in more modern situations now, we're doing this on apps like Venmo, Cash App, stuff like that. Like when you go to get the money in your account and it takes usually 24 hours or so to do that. It's because the two banks, the bank that I'm sending the money from and the bank that you're trying to put your money into, they have to communicate together at the Federal Reserve and exchange this cash. And so that's one of the things that the Federal Reserve does, and one of the reasons why it takes us so long to finish transactions this way. The Federal Reserve is run by what we call the Board of Governors. This is really important, and this really is just kind of like a review of bureaucracy in general, because this is showing us why these things are important here. But the Board of Governors is made up of these people make the decisions. It's got 7 members, and the president picks them, but they have to be approved by Congress. But here's the big deal. They serve for 14 years. And if you think about it, that outlasts any president. Okay, they are supposed to be outside of the control of the presidents and Congress. So once they're put into place, they're picked because they're economic experts. They may be Republican or Democrat, but they're picked because they are economic experts. And we do not want them feeling the pressure of Democrats and Republicans in Congress or the president. So that once they get there, they can't lose their job. They're going to keep that job for 14 years. So they don't have to worry about what the president wants. Like they don't have to worry about President Trump was like publicly critical of the Fed, and he was like, I think the Fed should do this or that. But the people that are on the board of governors of the Fed don't have to listen to him because they're going to keep their job longer than he is. So this keeps them independent from from political pressure. The chairman of the Fed is the person that we're probably going to see a lot. Like they speak for the board of governors of the Fed. This is Jerome Powell. He was appointed by President Trump to be chairman of the Fed, and he was on the board of governors before, so he's going to be the chairman of the Fed from 2018 to 2022. They're going to serve for 4-year terms, like while they're in their 14-year term, and they have like the final decision, and also they are like the spokesman. So we see a lot of them. They're usually a pretty public figure. All right, so how can the Fed impact us? The Fed has quite a few tools here that are pretty important. And the main one we're going to talk about is the discount rate. And that means that they are controlling the interest rate that the Fed charges a bank to take out a loan. That's going to impact how much the bank offers me at an interest rate here. So basically, like, I bank at SunTrust. So if SunTrust wanted to try to get me to borrow money, buy a house or something like that, they're going to borrow money from the Fed. And like if the Fed said that SunTrust could borrow money from them at 5%, then SunTrust is going to loan that money to me at like 7% so that they can make some money off of it. So the discount rate is a really important tool. The other thing here is the reserve requirement. The reserve requirement is the amount of money that a commercial bank has to keep in its account at the Fed. So the Fed might say that like all banks have to keep 25% of their money in accounts at the Federal Reserve. And that impacts how much money they have left over to like loan to us. The other thing they can do here is what we call open market transactions, which means that they are buying and selling bonds. So this is they are making decisions about when the United States borrows money from us. That's selling bonds. And when they buy bonds back, that's putting more money into the economy. So these are the three tools that the Fed uses: the discount rate, the reserve requirement, and open market transactions. All right, so we need to understand how these impact the money supply in the United States, because the money supply is going to be how they control the economy. So when they raise the discount rate, that makes the money supply go down. When they decrease the discount rate, that's going to increase the money supply. Same thing for the reserve requirement here. When they raise the reserve requirement, that's going to decrease the money supply. And when they decrease the reserve requirement, it increases the money supply. The one that sounds a little backwards to me is when they are dealing with the open market transaction. So when they sell bonds, they're actually decreasing the money supply. Basically, when they sell bonds, they're borrowing money from me. And what that means is when I give them money for a bond, they're basically taking money out of circulation, right? If I bought $1,000 bond from the United States government, they take $1,000 from me that otherwise would float around in the economy, and they make sure that it doesn't. The reverse, when they buy bonds, they're putting money into the economy. So if I had $1,000 bond and they announced, hey, we're buying back bonds earlier than we planned to, then that would be them giving me $1,000 for my bond. And now that's adding money that will float around in the economy. All right, so how does any of this impact you and me? We're going to talk mostly about interest rates here. So this is about the price of loans, and that determines whether or not you or I will go out and get loans. So it's basically the same ideas is what we were talking about with fiscal policy. But if the Fed lowers the interest rate, they'll increase the money supply. Now, what that means is that loans are going to be very cheap. When loans are cheap, people borrow more money. There's only one reason that people borrow money, and that is to buy things, right? People borrow money to spend it. And so that means that they're making demand increase. When they have lowered the interest rate, they've increased the money supply, and that makes demand increase, which means businesses get busier, they hire more people. And so when the Fed lowers the interest rate, they have reduced unemployment because they have caused economic growth. The opposite is also true. The Fed has to pay attention to inflation, make sure inflation doesn't occur. So when the economy is growing too quickly, there may be contractionary monetary policy. So the Fed will raise interest rates, and that will decrease the money supply. When they raise interest rates, that means that loans are becoming more expensive. So now, if the loan becomes more expensive, I'm less likely to borrow money. I'm probably going to save up for purchases. And if I save up, that means there's less economic activity than there was before. So demand decreases. Businesses have surpluses, right? Um, people are buying less. Businesses have to cut prices to get rid of those, and the Federal Reserve has taken an action that has reduced inflation and slowed economic growth. We made it. Finally done with all our economic policy here. We talked a lot about the tools of economic policy today, and here's President Trump showing off a very important tool of his Make America Great Again set of pliers. So I'm sure this is a wonderful set of pliers with Donald Trump's name engraved on them there. Got to get your own Make America Great Again pliers. And here is just a really awesome time where President Trump was trying to film a commercial with a live bald eagle, and it scared him a little bit. Whoops. We want to make sure today that we are able to explain the causes and the solutions to the two major economic problems. So we want to make sure we understand unemployment happens when the economy is too slow. Inflation happens when the economy is too fast, and it's up to the government to step in and slow it down or speed it up again. So think about the fiscal policy responses. Think about taxing and spending, and we want to make sure that we can explain the ideas behind Keynesianism, that the government should intervene, that this is a philosophy that some people have, that the government should intervene to slow the economy down or speed it up when necessary. We also want to describe the monetary policy responses. So this is the Federal Reserve. We want to make sure we understand why the Federal Reserve would use its power to change interest rates to influence economic performance. All right, that's it for economic policy. Now we've got a really good idea of what liberals and conservatives think about the economy. We've got a really good idea about what the president and Congress can do to impact the economy. And we've got a really good idea of what the Federal Reserve can do to impact economic growth or to slow the economy down. So now we're going to shift and talk about the current economic status of the country. We want to look at the income distribution and poverty in the United States so that we can start to understand the need for social welfare policies in the country.